Hey there, this is David Cox, Senior Portfolio Manager at Financially in Sync at Raymond James in Waterloo, Ontario, Canada. Today on the webinar, where do we investors stand? It is Friday, June the 27th, 2025. Let's get started. We will sort off by week. Last week we talked about crude oil bouncing in a downtrend, and you can see there on the bottom, it is down 13% this week, and we will look at that in a little moment. Growth stocks just continue to sort of perform very, very well, particularly a certain brand of kind of innovative growth stocks, which we will also look at. Just a reminder to pause your video player at any time for more details. Let's look at V bottoms. V bottoms used to be considered very irregular and not common, because essentially what you've got is the lack of stability. When a market falls, especially markets tend to fall faster or more quickly than they rise. Essentially, you often need what's called base building, where you have back and forth. And we've now had this is a third V bottom here in the last we'll call it 7 years. This is the S&P 500 on the left. This is exactly what we just went through, right? We had a March-April sell-off. And essentially, we're sitting here right at that prior high line. In COVID times in 2020, the same thing happened. Market just cratered, of course, lots of fear, lots of panic. And then again, the market came straight back, really without any kind of pausing. And in 2018-19, you can see the same thing happen. So again, the bottom line is we always need to be open-minded as investors, right? First off, we understand that emotions run high in terms of sell-offs. And again, there are always reasons to think that things will get worse. But the bottom line is that when markets are, going through corrective periods and sell-offs, we certainly need to be aware that V bottoms, they can occur, and they did occur this year again. This is important. This is the ARK ETF, again, full of lots of sexy growth stocks. And again, let's be honest, this has been absolutely obliterated over the course of the last several years. But this is the ARK versus the SPX, and that's the S&P 500. So what we've got is multi-year outperformance starting to happen. I think this is very, very important because it speaks to the environment. Some of you will recall, of course, that 2020 was just an incredible year for growth stocks and very, very exciting. And I think that there are lots and lots of stocks, an increasing number of stocks that are breaking out, and they're very, very exciting type stocks. And the ARK fund is one example, or the ARK group of funds rather, is kind of an example of ETFs that hold some of these funds, and I think are worth looking further into, look into the holdings and whatnot. Let's just zoom out. These are quarterly charts. So these are 3 months at a time, right? So we often look at, the short term, and of course, as investors, we're faced with daily headlines and all these kinds of things. But this is the quarter that's happening. It looks like I messed up the Bitcoin chart on the left side, but bear with me there on that one. But the bottom line is, here's Bitcoin on the left, the S&P 500, that's stocks in the middle, and gold on the right. All of these are rising, right? And what you really don't want is sort of evidence of massive distribution. You can see the sell-offs that have taken place over the course of the last 5-6 years here in these charts, and you can see those big black bars. And again, just pointing out in the middle, right, in the S&P. So absolutely true that in the event that this quarter, which is just finishing next week, early next week here, as the end of June comes around, if the market had closed way down on the low here of where we went to in early April, that would be a very, very black, big black candlestick, and that would be very, very kind of impulsive buying, and that would certainly also be the biggest bar against, but it is not. In fact, we are up at the top of that as the market sits here at new highs. So again, that's why candlesticks, when we look at price data, we always want to understand time frame, because time frame matters. Not all investors care or should care. I mean, honestly, most shouldn't care about what goes on day to day. Most shouldn't care about what goes on week to week. It's month to month and more importantly, year to year that really matters. And again, zooming out helps us to do just that. Let's look at oil here. So on the left side, we had talked last week about oil. Again, I just kind of love this chart, because on the left side here you can see oil bottomed 2020. In fact, I don't even know if we can say it bottomed. I mean, it was minus, right? It was free. Oil was free. You could get oil and a bag of cash for free. Oil bounced strongly after COVID, like many assets, and essentially we've been in a lower highs, lower lows downtrend in the last several years. I mean, there's really not mistaking that. And the Canadian dollar is quite similar, actually. So again, bottomed in COVID. We went bottomed here early February as tariff fears were growing. The Canadian dollar right now is sitting about 8.5% off its lows, where it went down to 67, I think, half cents. But you can see here, bigger picture, right? We got to continue to have perspective. So I wanted to show you here, in this case, 5-6 year charts. We've got lower highs here. We do have a lower low. So let's not get too excited here that start thinking the Canadian dollar is suddenly going to just surge. But the bottom line is that oil and Canadian dollars are quite related. In fact, I've done a lot of research in the past, and really kind of shows that oil is often led at both turning points, up and down, by the Canadian dollar. So again, more on that in the future again. Speaking of energy, let's look at 3 Canadian energy stocks. These are plotted in the bottom panel versus the XEG, that's the Toronto iShare, that's the the broad ETF. I've got Imperial Oil on the left, and Canadian Natural and Suncor are the two largest holdings that actually represent, I believe, 48, 49% of that ETF. And you can see on the relative charts here, Imperial Oil is running alone, right? And what I mean is that that's hitting relative highs. That's in a strong uptrend. Canadian Natural Resources is sideways at best, just kind of keeping pace with the ETF, of course, being a large contributor. And Suncor has really been a weak stock. This is, again, the importance of sometimes you can see things on the chart, but when you look at the relative performance, you get even more information, which is why I like to do just that. Value and growth. We've talked about this a bunch of times, but on the left side, you can see value. Even today, as we sit here, the market is at highs. Value stocks are not, right? They are sitting here in lower high territory with a lower low on the chart. And so again, lower lows, lower highs, that is a downtrend. That is a bounce and a downtrend, whereas growth stocks definitely printed a lower low, but now they have a higher high. And so again, that changes the pattern, right? That changes the evidence of demand and supply. So look at the InSync universe here. Just as the quarter ends, there will be a new screen next week. Very, very excited. Always like to do that. But again, strong stocks, especially stocks that have outperformed, even for 1, 2, 3, 4, 5, 10-year time periods, can have weak periods of time. And so in the last quarter, I just cherry picked just to take a look at the universe, what was in there of the strongest stocks. Celestica, Energy, Lundin Mining, and Cameco and Broadcom all massively outperforming the S&P 500 in the last quarter. Our clients owned I guess I should say 4 of them at one point, and own 3 of them today. On the right side, we got the weakness, right? So there's Wasco, Coke, Erie, and Texas Pacific, and Fiserv. So these stocks have been very, very weak, right? So again, when a market bounces, essentially you want all your stocks to go up, because essentially as a portfolio or as an investor, I think the safest thing to say is that, if you want your portfolio to rise, you want to own stocks that are going up. But I think this is another, kind of piece of evidence that time frame matters, right? So in the last quarter, these stocks were weak. Does that mean that they're ruined? Of course not. We want to always continue to zoom out, as I've said many times today already. Gold on the left side here, just continuing to consolidate. This is the physical gold Sprott ETF. On the right side, we've got gold stocks. I'm using the XGD here, but again, it's an uptrend. It's a small short-term pullback in an uptrend. Technology financials, although technology has been very, very strong, making highs, top right here, you can see financials have not made highs. The relative chart of XLK versus XLF remains in a downtrend. Again, downtrend, how are we describing it? This is not my opinion. I'm just saying it's got lower highs and lower lows on it, and there's really not much more to be said. I am not saying that technology will not be the leader or the dominating force as this market continues. I am saying that the technology versus financials chart is in a downtrend. Fact. Let's finish off with sector watch here, and you can see there's the banks bouncing a little bit. There's technology and financials that actually we just talked about, and there's the energy stocks coming down here with crude oil a little bit in the last week, and that is everything in between and where we're at as we round out a month, round out a quarter, and so many things happening. Please follow me on X. I'm at David Cox RJ. Thanks again for your time this week. This has been David Cox, Portfolio Manager at Financially InSync in Waterloo, Canada.